terms of exports of goods that come in each month. So 2.2 billion for the next 2 months. And if you add up remittances as well as service exports, you have about 900 million in terms of inflows. So your total inflows come to 4.1. And on your outflows side, as you can see, it's higher than your inflows, right? So you have starting off with your principal and interest payments. The CPSL did disclose that we have about 1.9 billion due just in April and May, and these are not months that you see very big SLDBs or any big ISB payments coming due either. So part of this could include things like ACU liabilities and some other swap agreements that are falling due as well. So this component of what we need to meet in the next 2 months, that is April and May, is still significantly higher at 1.9 billion. And then below that, what we have taken is just your essential goods. So you have your fuel, pharmaceutical, as well as your food and beverage imports that you need to kind of keep running. And also your intermediate goods, excluding fuel here, because you need those intermediate goods to come in if you want to kind of get those exports on the other side. So when you keep these two together, you can see that there's a 600 million gap that we need to meet in the next 2 months. And mind you, this is just factoring in the essential imports only. So we haven't really factored in any investment good imports, and we haven't factored in any type of consumer imports that can come in the next month as well. So you're running just 300 million each month deficit, just considering your essential imports alone. So what all this has led to, as you can see, this has been a running issue because our reserves have been depleting over time. And this has, of course, resulted in the sharp depreciation, which we've seen in the currency within the last month or so. So as you know, the currency was held at about 200 to 203 levels from about July onwards. And the recent float saw the currency depreciate by about 35% year to date. Of course, there's an initial kind of overreaction that you might see, and we've heard, rates of 400 kind of levels being quoted in terms of the unofficial rates. But if you really want to control excessive depreciation in the currency, one of the key factors you need to do is to increase your interest rates. And as you can see in the chart on the right, this is the blue line here is the T-bill auction rate of the last couple of months. And for the year so far, it has increased 730 basis points. And when you put that against your policy rates, which have only increased about 150 basis points, there's a bit of a mismatch. So what we're hoping for is that we start seeing much more sharper policy rate hikes and increased interest rates, and with the monetary policy statement that's expected today evening as well, where we would be expecting in the range of kind of a 300 500 kind of basis point hike to match the increase that we've already seen in terms of the market rates. So in terms of, again, showing what kind of a role interest rates play in terms of managing your currency depreciation, just looking at a few other countries that have done this in the past. So Turkey, of course, is a very sorry about that. Turkey is a prime example of using interest rates to defend currency movements. So Turkey does not shy away from very sharp increases in their changes in their interest rates. And we've seen very big increases, as you can see this blue line. So if I was to just talk you through this, the blue line is your lending rates, and the red line is the currency over time, right? So what we saw is initially the Turkish lira was seeing sharp depreciation pressure in 2018 with their balance of payments issues. And at the time, the central bank increased interest rates sharply, such that the lending rates increased by about 16% just within a 3-month period. So this immediately had an impact on the currency, which saw an appreciation of about 24% from the high that it reached at the time. Afterwards, Turkey went on to cut its rates quite sharply, but they did it over a period of time, about 14 months, that they kind of normalized it back to the levels that they saw early 2018. But this also saw the Turkish lira depreciating once again, about 29% over about a period of a year. Once the depreciation kind of started picking up, again, you see Turkey coming in and raising rates again very sharply, 10.75% in 8 months. And this again saw the lira appreciating very quickly adjusting very quickly to the interest rate hike, appreciating once again. So you see this kind of pattern continuing. where the currency depreciates, and an interest rate adjustment causes that depreciation to kind of be curtailed to the point of appreciation as well. And again, during the Asian financial crisis as well, this is something that we had seen. So here we have on the left the chart on South Korea. Again, similarly, when the red line, which is your currency, started seeing depreciation pressure, interest rates were raised very sharply. You can see it went from about 11% to over 26% on the overnight call rates. And immediately you see the currency starting to stabilize. And then they hold that high kind of level of interest rates for a period of time before bringing it down so that the currency has time to settle. Similarly, Thailand on your right, you can see that when there's depreciation pressure, which is your red line, the interest rates are allowed to increase very sharply, and this kind of controls the amount of depreciation that you see. And you wouldn't see the kind of the depreciation continuing beyond an extended period of time. In fact, it starts settling. So it depreciates overall, but not as much as it would have if the interest rate had not been raised. So from this point onwards, what are the kind of repercussions or what is an IMF program coming in right now really mean? To talk through the kind of process that it takes, so usually it will take about anywhere between 6 to kind of 30 on average. Sometimes it takes longer, and in a few instances it has taken shorter for an overall restructuring program to be agreed upon. So overall, what you can start off with is you have what we understand is that in terms of what debt kind of gets restructured, you can restructure your external debt. You can also restructure your domestic debt. Overall, bilateral debt also can get restructured, particularly if the bilateral partners are within the Paris Club. They have separate ways of negotiating. But for Sri Lanka, given that our bilateral partners are mostly India and China, and they are not in the Paris, they would be negotiated separately. And given that they've been quite accommodating over the last couple of months, this shouldn't be too much of an issue. What doesn't get restructured is your multilateral debt as well as your trade creditors. So the option is there on whether you restructure just your external debt or just your domestic debt, or a combination of both. And we'll talk through what we kind of expect on that front for Sri Lanka in the next couple of slides. So overall, you kind of they'll kind of lay out with the lawyers. They'll start laying out the kind of restructuring scenarios, and then you move into your overall negotiations. So overall, what the creditors would kind of want to make sure is that there's that it's overall equitable in terms of the haircuts that they take. They don't want to take more than another creditor has taken, so it has to be kind of fair overall. And they want to ensure that there's no backsliding on the part of the sovereign debtor, which is where the IMF comes in to bring in that point of credibility. So in terms of the types of debt restructuring, you can either move your maturity, which is a debt reprofiling, to move it a couple of years away without any haircuts. The second scenario is where you do have a haircut, which is on your principal amount only. And the third is on coupon adjustments, which is to reduce the interest rate on the debt. And the fourth, of course, is a combination of all of this. And typically, I think you do see combinations of most of these happening in several other countries. Debt profiling generally is kind of kept for countries that they don't have unsustainable debt. That is something that's more welcoming. But if you have unsustainable debt, they'll try to kind of work with a combination of one of these types of restructures. So in terms of what the IMF will ask for. So the basic ones they've talked about, particularly in Article 4, is in terms of the exchange rate. So they asked for exchange rates to gradually return to market determined or flexible exchange rate structure. So this was prior to the float, of course. One thing interesting here was that they said that they would enable and facilitate external adjustment in order to build international reserves. So the question is kind of raised here, whether they will be okay with the central bank going in to purchase dollars from the market in order to rebuild its level of reserves. In terms of the import and capital controls that have been implemented so far, they have again been a bit accommodating. They have said that the measures should be temporary, but they given time for it to be phased out. So they talk about import restrictions overall being phased out, and capital restrictions to kind of be unwinded as conditions permit. So they've been a little bit accommodating. So we're not going to suddenly see these import bans or any restrictions going away immediately as soon as the IMF comes in. It might take a little bit of time, but that is all kind of parts of not shocking the system and kind of containing your import and the pressures on your balance of payments overall, which is the intent of letting these things go for a little longer. On the interest rate front, what we've generally seen is that the IMF wants interest rates to be, real interest rates to be positive. So your nominal interest rate needs to kind of match at least your inflation rate. So in terms of inflation, it is on a very sharp rising trend. And because of the depreciation and the impacts of future tax increases that can come in, you might see kind of a step up in terms of your inflation, but we don't necessarily expect this to continue beyond kind of the next 12 months or so. But with inflation reaching above 20% levels on headline level, it means that your interest rates need to kind of rise in line with that, so that you have positive real interest rates that will kind of encourage savings and reduce overall consumption and pressure on the economy. So just to talk through what it means in terms of the fiscal balances as well as the external debt restructuring, I will pass it on to Udisha.
Thank you, Trisha. Thank you, Trisha. So when IMF comes into a program, one of the critical things that they first say is that you need to make your primary balance zero. That's the first step. And this is kind of the requirement that they want from all countries that they go through an IMF program, is to bring the primary deficit to zero. And the normal time that they give to do that is about 2 years' time. What you mean by primary deficit is your revenue minus your operating cost. So they want the country, without looking at interest, to make a profit level or revenue minus cost to be positive, right? So the general tendency is that they give around 2 to 3 years to get to a 0% primary deficit, primary surplus level, which means that from Sri Lanka's perspective, Sri Lanka at the moment is at 2.5% of primary deficit to GDP, right? So to get to 0% primary surplus, or to be neutral in terms of the primary balance, Sri Lankan government has to increase its revenue or reduce costs to create a positive 500 billion rupees impact in terms of additional revenue or through reduced costs. So incremental impact to the budget should be about 500 billion rupees. Okay? So what will this mean in terms of the fiscal adjustments that need to happen in Sri Lanka, and how will this kind of affect, right? So if you recall, 2 years ago, before the steep reductions were made in terms of VAT, where value-added taxes were brought down from 15 to 7%, income taxes were reduced, right? The impact of that measures was roughly about 400 to 500 billion rupees. So the first step would be to reinstate some of these adjustments or downward adjustments which were made during the last 2 years. You might have to reverse it back. And the larger adjustments will come from items like value-added tax, where the reversal in terms of value-added tax will add about 200 billion rupees. The income tax adjustments will be about 100 billion rupees. And also you can look at WHT on interest income. If you charge about 10% on WHT, you can earn about 80 billion rupees in terms of revenue. And reinstating things like NBT, special commodities levy, or your economy service charge could add another 150 billion rupees. So you're roughly looking at about 500 billion rupees in terms of incremental revenue to get to the primary deficit figure of zero in 2024. So the initial guideline given by IMF, the Article 4, is to get to 0% primary deficit by 2024, right? So this will mean that there will be a further increment in terms of your inflation, because when you increase VAT, NBT, and so on, there will be a step up increase in terms of your inflation levels. So if these measures are in place, Sri Lanka can get to a fiscal deficit somewhere between 4 to 4.5% by 2028. Normally, the time period that the IMF gives you is for about 5 years' time to get to a reasonable amount in terms of your debt to GDP, right? What we foresee as a reasonable level of public debt to GDP is to bring it down to about 80% of debt to GDP by 2028. Currently, we are at about 119%. Right? If you look at the previous IMF program that Sri Lanka was part of, the public debt to GDP target by 2023 was about 70%. Right? We feel, given the current climate, economic climate, and so on, that an 80% debt to GDP level by 2028 is something that IMF will also be comfortable with. Right? So it's not only just the adjustments of your fiscal deficit and increasing taxes that will be required to bring this debt level from a substantial 119% to 80%. It also requires other adjustments that the government might have to take. Right? From our perspective, we believe that on the foreign denominated debt, that a 20% haircut is likely and is a comfortable level that most of the financial institutions will be okay to take. Right? In addition to that, we also feel that there could be monetization of non-strategic assets by the government, which could work out to about $2.5 billion, which will reduce the government's debt burden in the initial years. So in 2023, we expect a 20% haircut on foreign debt. And in 2024, by the time we kind of restructure SOEs and also look at monetizing some of the non-strategic state-owned enterprises, we can reduce our foreign debt burden by roughly about $5 to $6 billion. And what will an external haircut mean to a local banking system? Right? So as we know that the local banking system holds roughly about $1.7 billion out of the $12.5 billion of international sovereign bonds outstanding. And in terms of the Sri Lanka development bonds, the banking system holds roughly about $2 billion. Right? So when the external debt is restructured or foreign denominated debt is restructured, the most likelihood chance is that the ISBs and SLDBs held by the local banks will also kind of take a haircut. Right? So we feel that a 20% haircut on foreign denominated securities is likely. And looking at the last few, the kind of haircuts that we've seen in the last post-2016 kind of period, a 20% haircut is a decent haircut to take, and which will help us to get to that 80% debt to GDP levels, right? So if that was the case, if you work out what kind of capital buffers that the banks will have post cutting down on their or taking a haircut on their foreign denominated debt, most banks will be comfortable in terms of meeting their tier 1 kind of requirements in terms of capital requirements, and liquidity also will be comfortable. The 3 banks which will be not falling within that comfortable capital buffer will be likes of National Development Bank, the Government Bank, Bank of Ceylon, which can be recapitalized by the government, and also Commercial Bank, which will fall short, which can be has the capacity to kind of raise money and kind of fill in this capital shortfall that they will see. So we feel that a 20% external haircut will be comfortable for the domestic banking system to kind of bear. Right? But a bigger question, and which has been a pertinent question, is whether the domestic sector or the domestic debt will also have to take a haircut. Right? If we are to bring down our debt levels to about 80% of GDP, to be honest, we do not need a real domestic debt restructure. And IMF is very clear in terms of that it is not mandatory that countries need to go for a domestic debt restructure as such. Right? So one of the quotes put in one of the IMF articles is that domestic debt is like surgery. You only do it if it is a must, and you can avoid it if it's going to do more harm than good. So what you need to look at is whether by the financial institutions in Sri Lanka taking a haircut on domestic debt, if that burden to the financial system is going to be greater than the debt saving that you're going to get through restructuring, if the impact is going to be greater, don't do it. Right? So if you look at the Sri Lankan domestic banking system, If you look at the bills and bonds of the government that is owned by the commercial bank, the commercial banks own roughly about 30% of the total T-bills and T-bonds outstanding. So a fairly large components of T-bills and T-bonds are held by the commercial banks. Right? So penalizing them with a 20% or a 10% haircut will be substantial hit given the quantum of bills and bonds that they're holding. So the impact to the financial system will be substantial, and which is what IMF wants to ensure that doesn't happen in a restructuring program, right? So we feel that a domestic restructure is not required at the moment for us to bring our debt levels to a comfortable 80% debt to GDP by 2028. If you are really keen on penalizing your domestic debt system, IMF also suggests two alternatives. One is to either reprofile your domestic debt where you postpone your maturities for a couple of years, or reducing your interest rate only by a certain percent on the domestic debt component, which is ideally bringing down your yields on treasury bills and bonds by a certain percentage and not taking a principal haircut. Right? So, just a second. So if the Sri Lankan banking system were to take both a 20% haircut on external debt and a 10% haircut on domestic debt, right? We're looking at a worst case scenario here. As you can see, a lot of the banks will have a shortfall in terms of capital, right? Which is what the IMF says that you should avoid, right? If such a scenario persists, it means that the government will have to kind of recapitalize the banks and so on, which is a costly affair. So to be honest, we don't need this kind of scenario where the banks will fall short in terms of capital. So what IMF says is take a comfortable level in terms of what you can do on domestic and international borrowing. So what we prescribe and what we feel is a comfortable level is just do the 20% foreign haircut on foreign denominated debt, which will comfortably put you onto a position where you can meet the bring your debt to GDP by 80% by 2028. Right? So we have also seen in the past where countries have gone through a domestic restructure, there have been certain instances where there have been certain segments have been excluded from taking a percentage cut on the domestic debt restructure as well. So in the case of Barbados, where 53% of the financial assets or the domestic assets were owned by the banking system, what they did during a domestic restructure was to exclude the banks and insurance companies from the domestic restructure, right? So and this was made as what I mentioned to protect the domestic financial system stability, right? So there are situations where the IMF is okay to kind of allow countries to not take cuts on domestic debt and exclude it for particular segments. So you can make it exclusive for certain investors and not for banks and insurance companies as such, right? So we feel that the base case is going to be where foreign denominated securities are going to take a haircut, but we don't see a possibility that and a requirement to really go for a domestic debt restructure as such. And if we are to kind of make the fiscal reforms that the IMF prescribes, one of the few things that they would want to do is to price energy or fuel to market prices, so that your government entities like Ceylon Petroleum Corporation and Ceylon Electricity Board don't make losses on operating profit. So if you look at the CEB right now, the CEB, the rate that they're charging right now is about 16.8 rupees per kilowatt of a unit, and the cost of generation was about 21 rupees in 2020. Also keep in mind that the prices of coal, fuel have gone up, which increase and with the impact of the rupee depreciation, the cost of power generation has increased to about 32 to 36 rupees a kilowatt in terms of cost, right? So ideally, you have to see in a scenario, you will have to see the pricing of electricity being almost double to kind of match the cost of electricity generation. So it could be a substantial increase in terms of energy or electricity tariff revision if fuel prices or coal prices were to remain at these elevated levels. Right? From a fuel price perspective, at the moment, the prices charged by Ceylon Petroleum Corporation is about 176 rupees on auto diesel and 254 rupees on petrol. If you were to match the global prices and to be neutral in terms of or break even in terms of CPC operations, the prices of 92 octane should be somewhere close to 322 rupees and roughly about 270 rupees on auto diesel. So a substantial revision is still required on fuel prices if fuel and if petrol, diesel and coal prices were to remain at these elevated levels. But if there is a downward adjustment on global prices, obviously you can look at a slightly lower adjustment, but a large adjustment is also coming from the rupee depreciation impact. So just to touch on, so what we are seeing right now is there's going to be severe fiscal reforms, which means that your energy pricing is going to be way higher, and there's going to be a phase of taxation increase in terms of value-added taxes, direct taxes, and so on, which will most likely mean in the interim where taxes are going to revise back to where it was in 2019 levels. So that would be the first phase that we're going to see in terms of the revisions that we're going to see. So it's going to have a step-up increase in terms of inflation in the short term, where we're going to see inflation, which is at about 18% right now, going above 22-23% kind of levels in the next 6 to 12 months. What will this mean to our financial markets? I'd like to invite Trisha to give a brief in terms of what can we expect in terms of the impact it would have on the financial markets.
Thanks, Adishan. So I'll kind of run through a couple of other countries that have been through either a default or a restructure or some kind of IMF program to see what impact it has had in terms of currency, in terms of interest rates, and also in terms of how the equity markets performed. We can maybe take some examples of this for Sri Lanka, but I wouldn't say that this is necessarily how everything always works out, because specific country situations also do matter, and what kind of led to the crisis also does matter in terms of the impact that you would see on all of these variables as well. So starting off with, in terms of the currency volatility, of course, is of a default or a restructure. And here we have taken 3 examples of Pakistan when it restructured its debt towards 1998, 1997, 1998, around that time. So here you can see soon, prior to actually going to the IMF and starting on a restructured program, they did have a devaluation of the currency. It was a 4.4% devaluation, but the currency adjusted much more than that. And that was in efforts to kind of contain a balance of payments issue that they were having at the time because of sanctions that were imposed the year before and so on. The IMF, of course, came in about a year later, because the currency had already adjusted by then, the message of a preemptive restructuring didn't necessarily have an impact thereafter. In the case of Argentina, and with its most recent default, we can see as soon as they announced kind of the postponement of a payment which happened towards August, it was also coupled with change in government and some elections that were held at that moment. So at that time, you can see that the currency increased from about 40 levels to about 60 at the time. And since then, it has continued on its upward trajectory. We can see when it actually defaulted, which was around May of 2020, the currency was continuously depreciating. And this is kind of a trend that we've continued to see. And more recently is when they had really kind of finalized on a proper IMF program, which was just within the last couple of months or so. The third example we have here is in terms of Ukraine. So they did have a debt restructure in 2015. So here we can see the request of the IMF program in itself caused a very sharp depreciation in their currency. Of course, it adjusted a little bit after that. And once the IMF program was actually confirmed, you didn't see as much volatility, but the currency kind of remained on a depreciation path. So what this means, I would say, for Sri Lanka is we've already seen that bit of volatility with the float of the currency, and with an IMF program, while there could be, several bouts of volatility that we might see going forward, we don't think that the level of depreciation is going to kind of continue at the current pace, and it can kind of get limited over time. And we'll talk through a little bit more in terms of our views on that a little bit later. In terms of the interest rate movements, so here we have a couple of examples from Mozambique and Zambia. So Mozambique actually prior to 2016 had an IMF program, but because of certain issues in terms of how they had raised some of their debt, which was not done kind of through the legal process, the IMF actually backed out because it violated one of their clauses. And as a result of that, you saw the lending rate increased at the time. And then they started kind of moving finally towards a restructuring plan with the IMF. And we saw interest rates tapering off a little while later. So in terms of Zambia as well, the elevated interest rates actually were prior to an IMF program being agreed upon, but it was an issue that had been occurring since about 2020, when they went through kind of a severe balance of payments crisis because of copper prices, which fell sharply, and that required them to kind of start adjusting a lot of their exchange rates as interest rates overall. So interest rates overall here, as soon as Zambia and IMF announced the bailout package, saw a slight increase, but we didn't see too much of an increase from where it was before. In terms of Greece and Argentina, I think both of these countries show you that there can be a lot of volatility in interest rates. So Greece, of course, as you know, went through several rounds of talks, bailouts from EU and such. But overall, interest rates were on an upward trend even prior to this. And it was only once things started settling down and the debt structure was completing that interest rates kind of tapered off. Similarly, once again, in terms of Argentina as well. So I think the overall message here is that there can be bouts of volatility again in the interest rates as well. But overall, what we see is that interest rates tend to go up quite sharply when it does because of the kind of interest rate hikes and austerity measures that are put in place. But it does taper off after some time, although it does remain at those elevated levels for a period of time. Moving on to equity markets. So here we have Pakistan once again. So Pakistan, with their initial devaluation, which we saw before the IMF program coming in, had a sharp negative reaction on the market. It fell by about 44% prior to the announcement. But once the preemptive restructuring was put in place, the stock market actually picked up and it went up about 70% in the next 6 months, and it has kind of strengthened since that point. But I have to say that this Pakistan's instance was actually a program where the restructuring was kind of agreed upon over a kind of a faster period of time. So they were able to settle things faster, which is why you probably would have seen the stock market recovering so well. In terms of Argentina, again, the most recent time, here what we can see is that there's a lot of volatility. So what we see is typically in the months prior to the default or a repayment coming due, that the stock market kind of maybe prices that in, and you see a sharp fall. And once it's actually completed and the postponement is announced, you see it picking back up once again, only to fall again before the next payment comes due, and then picking up thereafter. So here you can see there's very sharp very sharp movements in terms of how the stock market can move. And this has been a bit unique, I would say, to Argentina to see this much volatility. Another example here, of course, is Lebanon as well. So Lebanon, prior to the default, it fell by about 20% in 2 months before they defaulted. And thereafter, it stabilized for a little bit. Even with the Beirut explosion, it didn't react too much. The more recent uptick that we've seen in 2021 and 2022 very much was driven by one particular stock, which was Solidaire, which is exposed to the real estate market because it attracted a lot of attention because it was acting as a hedge against the very high levels of depreciation and inflation that they were seeing. So as a result of that, because the Lebanon stock market itself only has about 15 listed entities. So because of that, you saw this one or two stocks which was related to this company driving the stock market rally over here. But if I was to kind of put a couple of other ones also together here, I think what I want to say is that equity market movements are not a one size fits all. It isn't necessarily the case where the stock market falls before a restructure and then picks up back after. There have been instances where it either stabilizes at its low levels and pushes up a little bit later, but there are also instances where it doesn't react as much and continues to rise, as is the case particularly with Argentina that we have seen. Moving on in terms of a couple of other indicators that we can look at, what happens to growth when there is a debt restructure? What we see is that growth typically declines in the lead up to a debt restructure. So in the years prior, so here in the gray kind of lines, you have several countries. The one that's kind of standing out as a continued downward trend is Greece. But what we can see is that on average, about the year of restructure as well as the year before, you'd see a decline in your GDP growth levels, but it does pick up once the restructure has been announced and completed. So and it would kind of recover back to positive levels and continue thereafter. So even if we do see a GDP growth kind of turning negative this year or next year, depending on when the restructuring is finally agreed upon, probably going to be this year, we'll see a period of recovery coming back after that. So it's not necessarily one where you will continue to see negative GDP, but we will see a recovery going forward. And in terms of your trade deficits, as you can see, GDP declines as a result of import contraction and interest rates and all of that. And that, of course, means that in trade balances in the period of default actually improve. So we can see T here being marked as the year in which the restructure was done. You can see the current account balances, in fact, improving and in some instances turning positive in the year of a default and just after, before it kind of reverts back to its back to a kind of a negative trend. But overall, the fact that the GDP has been slowed because of high interest rates, import crashing, private sector credit being really contained, you see an improvement in terms of your trade balances in the period of a default. So in terms of a larger question, I suppose, is that whether a hard default is still possible. So the big repayment, as we know, everyone talking about, is the 1 billion that's coming due in July. But as I mentioned right at the start, we do have quite a large shortfall that we need to meet in the next couple of months as well, and are continuously running at negative because of the lack of inflows that we're seeing so far. So a hard default at the moment, particularly if there is continued political instability, is definitely an option that could take place. We're not ruling it out completely, but we are of the hope that things can get negotiated, particularly for the July bond, rather quickly, and that they will meet the next couple of coupon payments as well, to avoid any further negative impact that a hard default in itself can have on the economy. So we're not necessarily ruling it out, but it is a possibility given the shortfall that we're running. But we're of the hope that with the new central bank governor in place, that things can move a little faster in terms of an overall IMF program. So to just sum up overall what we've been discussing so far, overall what we need right now is some level of political stability, because we need that in order to move on with our negotiations with the IMF in terms of an IMF program and the debt restructuring. Yes, of course, we can have the lawyers and all of that in place and the advisory committees, but we do need a functioning cabinet or a government or a finance minister really in place to continue with these discussions. And as we know, there was a meeting scheduled in next week or so, and we do need that to kind of continue if you want to move on this quite fast. At the moment, based on the most recent news, it is looking quite positive that this can happen quite quickly. And in terms of GDP growth, as I mentioned, it will be quite poor in the near term, but we do expect a recovery. Overall, what we think is that because of the pressure that there will be in terms of domestic consumption once interest rates are raised, and given that the fiscal tightening is going to see very limited capacity in terms of investment and infrastructure spending from the government side in order to stimulate growth. It's going to need them to encourage a lot more growth to come from external sources. And this means encouraging FDIs, encouraging tourism to come in faster, and developments in terms of the port city, making businesses easy to set up. All of those kind of processes need to be in place if you really want to stimulate growth from the external front when the domestic front is so kind of contained. And in terms of inflation, like we mentioned, we think there will be a step-up increase overall with the tax changes as well as the depreciation that we've seen already and the tax changes that are to come. But it could ease thereafter, because once interest rates have risen, consumption is contained, your overall demand side of the equation contracts, and eventually once global commodity prices either stabilize or come off, that could help us as well. And once the agricultural supply, which has been kind of a trying point that we've had in the last couple of months, pushing up food inflation as well, once that settles down in the next harvest or so, we could see inflation start tapering off. So in terms of interest rates overall, we don't think it has peaked. We do think there's more to go, particularly with the IMF asking for positive real interest rates. And we think that higher interest rates are necessary in order to contain any excess volatility and further depreciation on the rupee. And this also means that it reduces the burden of central bank financing the fiscal deficit, because it will improve the level of market subscriptions overall. So we do think interest rates have more to go. And as we've seen in the case of other countries, we do see kind of a sharp increase in interest rates that can persist for a little while before it starts coming back down again. And in terms of the exchange rate, we think that while there can be some bouts of volatility because of the uncertainty that we might see in the next couple of months, and maybe the shortages that we might face in the next couple of weeks or so, there could be some volatility. But overall, we think that if you're looking at it from an end 2022 perspective, we think that the currency depreciation can be a bit limited. We think once tourism and remittances do start coming in, that this could actually lead to even some level of appreciation pressure. But the question here is whether the central bank will start purchasing dollars from the market in order to kind of build back their reserves, which could limit the amount of appreciation that we might see. So we think the currency could stabilize at its current levels or even come off a little bit from now, but we're not going to see the continuous depreciation that we have been seeing in the last couple of weeks continuing. To move on in terms of what we overall think in terms of asset classes, I will pass it back to Dishan.
Thanks, Trisha. Yes, so as you know, from an investment perspective, the biggest question is, what do you do now, especially after you've seen your real income reducing on a dollar perspective? How do you kind of tilt your portfolios right now to kind of weather through this storm and kind of make real returns which can cope up for inflation and so on? So one thing I would like to note is that as what Trisha mentioned, in terms of inflation, what we expect is a step up increase. Right? So with the tax increases coming in and also the delayed impact of the rupee depreciation, we will see a step up increase in terms of inflation. But this doesn't mean that inflation will continue to go up in the next 3-4 years if the central bank doesn't kind of keep printing money. So we feel that there could be a step up increase in terms of inflation, and there will be thereafter a plateauing effect, especially when global commodity prices coming down, when the demand kind of slows down with the impact of this economic slowdown kicking in, and also the curtailment of printing by the central bank. So when interest rates are going to be pushed up, we're going to see a lot of the money printing kind of reducing on a gradual basis. It might not happen overnight, but we are going to see the level of money printing reducing on a overall basis, right? So if that was the case, one interesting asset class that we would really overweight ourselves is on the bonds. We feel that rates are yet to peak. There is probably another 500 basis points increase that we could expect on the bond yield. So if you are able to kind of lock in your yields when bond yields hit 20% plus premium levels for 3-4 years, then you could beat your inflation, because inflation is going to be probably there for the next 12 to 15 months. But if you lock in your yields at 20% plus periods, you can ideally grow your wealth, or you can double your portfolio in 4 years' time. So we feel that this kind of scenario is going to happen very soon, where you're going to see treasury bond yields being at 20% plus levels. And we feel that at those levels, it is ideal time to lock in your rates for longer term instruments. From an equity perspective, the reaction for higher interest rates, the impact of debt restructuring and so on is already being felt right now. We've seen the index fall from a high of 13,500 now close to at 8,000 levels. But the really interesting thing is, if you convert your market cap to dollar terms, your current market cap right now is even almost close to what it was before the pre-pandemic levels. So we feel that a lot of the stocks have got beaten really badly, and especially a lot of the fundamental stocks are trading even below pre-pandemic levels, and even below 5 to 10 year lows right now. So we feel there is opportunity right now, but there will be a little bit more negative volatility that we feel that we will see in the market. But at that time, we feel that that is a point that you should get into equities. If the government and the central bank take the route that the IMF and make the relevant changes in terms of the fiscal policy, we could see improvement in terms of the economic outlook in 2 years' time, which means that equity, in anticipation of that, would start moving ahead in a year's time. So ideal time to get into equities would be if you wait a little bit and get in when the negative volatility kicks in. You would be able to kind of really capitalize on low prices on equity right now. In terms of other asset classes, gold, we feel is overvalued right now, especially in the local market. Gold is priced at the curb market rates. So we see the curb market rates coming down right now, and gold prices will come down. And also on a dollar pricing basis, gold is at historical high right now, or close to $2,000 levels. When the US Fed starts hiking the rates, it's going to bring down inflation globally, and which will also put down global gold prices as well. So we don't see at this point gold prices are a great asset class to be in. In terms of real estate, we feel that even though the replacement cost of a lot of these assets have gone up, the high interest rates will be an impediment for growth in terms of the real estate prices right now. And keep in mind that it's a scenario where looking at demand is going to be very curtailed. It's going to be curtailed, given that you're going to see 2 years of curtailment in terms of GDP growth, which means that demand for property is also going to be lower. Right? So you're unable to, even though your replacement cost is going to be high on property, you're not going to be able to charge that kind of pricing and be able to kind of execute transactions at those levels right now. So gold and real estate, we feel, are no-go at this point. The attractive asset classes right now are bonds and equity for us right now. Bonds, it could be either even government bonds or even private debentures on good fundamental companies. Keep in mind that looking at fundamentally strong companies are very important, because the economy is going to go through a little bit of turbulence. So sticking to your core strong companies are critical, even when you're looking at private debentures as such. So the two big asset classes, debt and equity. Bonds for long term, equity capitalize on the downward negative volatility. You won't be able to pick the bottom, and at that point you won't have liquidity. So and when you see the negative volatility starting, I think that's a point you should start building your position, not in one go, but gradually start accumulating stock. But your investment horizon is going to be that 2-year period that Sri Lanka is going to go through in terms of correcting itself from a growth and fiscal perspective. Right? So that's our overall view in terms of what we're looking at from a macroeconomic perspective, and how IMF will kind of play out. We can now start taking in questions. We have a couple of questions coming in from the audience. The first question is, does IMF lend to countries with unsustainable debt? So for countries that have unsustainable debt, the IMF generally does not lend unless the member is taking steps to restore debt sustainability, right? Which means that even if Sri Lanka is classified as unsustainable debt, there is a possibility that we could get some kind of funding from IMF if we go on a debt restructuring path. So if we are doing haircuts and so on, and if we are showing that we are in a position to reduce our overall debt levels over a period of 5 to 8 years, yes, we could get some level of IMF funding. In the absence of IMF funding, the most likely scenario is that we will get bilateral support if there is a strong fiscal consolidation process in place. The other question is on can IMF help a country before debt restructuring if it has unsustainable debt? So can a country get IMF help even before debt restructuring is in place? According to what we understand, yes, there is a possibility that a government can get IMF financing even before a company goes through restructuring in an unsustainable debt scenario. The possibility that it could happen is if the bilateral lenders kind of provide IMF with assurance that the country under consideration is taking the necessary steps to debt sustainability, then there is an option where IMF will kind of chip in ahead of the restructuring is complete. So, for example, if bilateral lenders kind of give us assurance, give IMF the assurance that there is going to be that Sri Lanka is going to take a stable path in terms of going through a fiscal consolidation phase. Yes, there is a possibility that the IMF could lend ahead of the whole debt restructuring process being complete. So we can't completely rule out the fact that that IMF is not going to give you any money. There is still a remote possibility that you could get some IMF funding also, in case even if we are classified as unsustainable debt as such. The next question is, what would be the impact of debt restructure or haircut to the local banks? What I mentioned, if it's just a 20% kind of external debt restructuring that is required, most of the banks are comfortable in terms of meeting that, given the capital adequacy ratios that they're maintaining. So they're comfortable in terms of capital adequacy, apart from 3 banks which are falling short, namely National Development Bank, Commercial Bank, and the Bank of Ceylon, which might need a bit of recapitalization to kind of pull them through. But it's not a huge deficit that we are seeing in terms of what needs to be financed. But if there is a scenario where domestic debt restructuring also need to be done, which we feel is a very remote possibility, right? Then the capital shortfall could be fairly substantial. As I mentioned, roughly about 8 or 9 banks in the financial system will fall short of the tier 1 capital requirement. But as what I mentioned, the IMF is very clear in terms of if there is going to be a domestic financial system collapse or issue of that regard, you don't have to necessarily do it, not necessarily do it. And we feel that given that we can bring Sri Lanka's debt to GDP levels to about 80% plus levels in the next 4 to 5 years, we don't really necessarily have to kind of go for a domestic debt restructure on the rupee bond side for the local banks. Srisha, I think if you could answer the question, what will be a positive move or investment at current situation, keeping in bank or stock market or real estate?
I think I think as Udishan mentioned in that last slide, I think at the moment a positive move would really be kind of capitalizing in terms of your treasury bills and locking in at the very high rates. Bank deposits in that sense can be a safer asset, safe asset in terms of kind of beating your volatility at the moment. But if you really want a high return, you might want to move into something like treasury bills or bonds. Stock market, I think at the moment, as we mentioned, I think there's a little bit more to go in terms of reaching a final bottom, but it's not going to be easy to time that. So you kind of want to average it out, and because as Udishan mentioned, there's not going to be as much liquidity once you get right to the end of the bottom, but you want to kind of position yourself in somewhat of a liquid state so that you can really take advantage of buying some of these stocks at very cheap prices. Real estate, of course, we don't think at the moment it's going to be too favorable given the high interest rate environment that we are just heading into, and kind of much higher levels of interest rates than we have seen in the recent past. So at the moment, real estate is would not be necessarily a great option that we are seeing. So at the moment, I would say probably getting into bonds is probably the best investment kind of move that you could make at the moment.
Also, just a point to add, in turbulent times like this, especially when you're going to see a high interest rate scenario, especially with the government being the fueler of interest rates, there are times where the bank deposit rates will be lower than the government securities yields. So your bank deposit yields might not give you the same yields, but as a government securities or a debenture will be giving you at that time. So you will have to look at kind of tilting your portfolio out from bank deposits to other alternative asset classes and kind of capitalize the movements on bonds as well as equities. Next question is, how could debt restricting possible? Is debt restricting possible? Not tinkering local banks. So the question, just to summarize, is that can the local banks, avoid a restructuring when everyone else is taking a restructuring as such, or the external parties are taking a restructuring as such? So since the ISBs are governed by international laws, it is not possible to avoid a debt restructure on the ISBs for the local banks if every other lender is taking a haircut on international sovereign bonds. So most likely scenarios like what I mentioned. On the ISBs, yes, the banks will have to take a hit if every other lender is also taking a hit on the sovereign bonds and on the bilateral funding as such. But SLDBs, even though we are expecting that their SLDBs could take a haircut of 10 to 20%, there is a possibility that you can argue against the SLDBs not taking a haircut as such. And the argument is that the domestic debt is, the SLDBs are held by the local institutions, especially the banks. The domestic system is bearing the hit of this financial, of this restructuring through also in terms of tax increases, interest rate hikes, and also in terms of the currency depreciation. Because the domestic system is already taking a hit, the domestic debt holders can argue saying that because they already take a hit on multiple aspects, that their haircut could be lower than what an ISB holder would take. So there is a possibility that SLDB holders can negotiate for a slightly lower haircut compared to the international sovereign bond holders. Right? So, or else even for the SLDB component, you can ask for reprofiling or postponement of the payments rather than asking for a haircut as such. So on the SLDB component, yes, on the development bonds, there is a possibility that you can avoid the haircut scenario. In our base case, we are factoring in both the ISPs and SLDBs held by banks going through a haircut scenario.
I also have one question that has come up on chat. In terms of the inflows from tourism and remittances, at what level are we estimating the monthly quantum? So at the moment, what we've seen is in terms of remittances, we've been getting about 250 million, just about over 200 million or so the last month. And in February, I think it was a little bit higher than that. So for the moment, we're not expecting a very sharp pickup. I think what we'd be expecting the next couple of months is about 250 million coming in terms of a monthly estimate. At its peak, remittances did bring about 7 billion or so, which is about $500 to $600 million a month. In terms of tourism, again, it has been picking up a little bit slowly. We've had just less than 200 million or so in the last couple of months, February being a little bit higher than January. So what we'll be expecting going forward is maybe another 200 million or so if you were to be a little bit conservative on that front. Again, at its peak, we saw remittances bringing in about 4.3 billion annually. That was in 2018, which goes to about 400 million or so a month at that rate. In terms of why it's not being converted into the LKR with hard currencies ending up in CBSL reserves, which is also a question on that. At the moment, what we're hearing is that what we know is that remittances, of course, once it comes into the bank, it has a 50% surrender requirement. So it is kind of being put into the central bank reserves and taken from the banks at this point. In terms of tourism, There was a central bank circular earlier on this year that said that hotels have to kind of accept hard dollars in from to foreigners, and what we're hearing is that that is for the most part being adhered to. So we do see a lot more hard dollars actually coming in, and instead of tourists kind of converting into LKR and then paying the LKR rate, they're paying it in terms of dollars at the moment. So there is a conversion in terms of the remittances, and it is going into, in terms of tourism, it is going into kind of the businesses at in terms of a hard dollar rate rather than a conversion to rupee.
Sorry, and one other question asked is what should be the right route to take in terms of from here, from a political perspective, in terms of and what the authorities should be doing right now. So the prudent step should be increase interest rates. If you push up interest rates, it kind of reduces the pressure on exchange rates, as what Trisha mentioned, because the borrowing pressure reduces, but it shrinks the economy, but the borrowing pressure reduces, which means your imports reduce, and you see a substantial reduction in the import. So that basically reduces your imports, and also from the other side, you will also see more money coming into the country, especially worker remittances as such, where we will see a gradual improvement on worker remittances in the next couple of months. But the one thing which is kind of postponing worker remittances at the moment is the inward remittances. The guys who are sending money need to see a stable economic environment and stable policy environment. So the government, from a government perspective, as long as they're committing to an IMF program, the message comes across, you will see an improvement on the remittance side in the next couple of months. And that also means that, and when you see, and what typically happens is that when money starts flowing in and there's a slight appreciation of the currency, you might see more people starting to convert. So at the moment, what happens is investors take a wait and see approach in terms of without converting currency. But once you see an improvement in terms of money coming and so on, there is an acceleration in terms of the conversions that you see from the market, which could improve your currency position. And also, what we feel the right thing to do is, in terms of prioritizing the essentials, ensuring the money flowing into essential is prioritized, rather than putting the money into foreign debt repayments and so on, because most of it is going to be restructured anyway. So we feel that by ensuring that the essentials, the money is flown or brought into essentials, you can at least ensure that the money is coming into tourism, there's more arrivals coming in, and there is a smooth flow of economic activity in the country. So priority is to ensure that that a lot of the money that is surrendered from worker remittances to the central bank right now is getting channeled towards the essential imports, and rather than not committing it towards making payments for foreign debt repayments as such. There is also a question in terms of, is there a possibility of increasing energy sector by 3 to 4 times? We feel the overall electricity bill or electricity, the revenue that the CB has to make has to almost double, given the current situation, if the commodity prices don't ease off, right? At minimum, even if commodity prices ease off, there needs to be at least a 50% kind of increase in terms of energy tariffs, because you have to adjust for the rupee depreciation impact. And given that roughly about 70% of our electricity generation is coming from coal, which is about 40%, 30% from thermal electricity, there needs to be an adjustment of roughly at least about 50%. But that it doesn't necessarily mean that all categories in terms of users will take the same hit. So it might be a scenario where the low brackets, which is below 90 units or so, might be taking a higher hit compared to the ones in the top bracket. So the distribution might be different, which is why each user might not be taking the same kind of electricity tariff hike as such. So this is definitely pending, and which is required for for you to neutralize the government's debt burden right now?
There's also a question in terms of what would the most likely IMF program look like, whether it will be only restructuring or some level of funding as well. At the moment, what we're thinking is usually with an IMF program, while there is a restructuring, it also does come with some level of funding. The quantums, of course, can change depending on the country and what their quotas are. But generally, we would see some level of funding coming. Typically, it has been in the past for Sri Lanka without a restructuring, it has been about 3 billion or so in terms of a 3 to 4 year program. So you're not going to get a very large quantum of money in itself. At most, you probably get maybe $400 million a tranche. So you get about 800 to somewhere between 800 to 1 billion, maybe a year at most, I would say, at the moment. But the impact of the IMF is not necessarily just in terms of the quantum of funding that it can give you. It is very much a signaling effect that brings in the other funds. You'll see much more bilateral financing kind of being unlocked. You'd see multilateral agencies being a little bit more willing to kind of engage in terms of projects and developments coming in because of the fact that they kind of expect that you are on kind of right path in terms of fiscal and things like that. But we've also seen in terms of if you do follow through with a restructuring program as well as an IMF program, that you could start accessing capital markets sooner if you do kind of take countries that have taken larger haircuts and have really seen through in terms of all of the targets have seen access to capital markets coming in within about a year or so. But you can also kind of on average see being able to access funding access funding in terms of a commercial markets within about 3 years once your credit ratings really start adjusting. So in terms of whether it's funding or debt restructuring, it's going to be kind of a mix of both. You will see some restructuring, but you'll also get some level of funding, but that funding is not going to be very substantial in terms of meeting your balance of payment needs.
There is also a question in terms of whether there are vulture funds among the holders of ISPs right now. To be honest, the percentage, according to what we know, the percentage of vulture funds who are kind of invested in ISPs right now is very small. So large part of the recent ISPs which came in during 2020s were purchased by the local commercial banks in general and a few institutions attached to Sri Lanka as well. But the component of vulture funds being invested in ISPs is, according to what we know, is not a fairly large component. Also, there is a question on does it make sense to invest in primary leadership companies that are listed in the Colombo Stock Exchange? To be honest, we have a conflict of interest in terms of answering this question because our parent is linked to a primary dealing company. But what I could say is that primary dealing companies make money when rates come down, and it all depends on timing and whether they get those timing right. So if you buy bonds when rates are going up, you can obviously lose money. But if you time it right and if primary dealing companies buy it at the right time when rates are peak and from there rates fall, that's the opportunity. That's the point at which primary dealing companies make money. So it's about timing and how well the primary dealing companies get their timing and the leverage at that time correctly. I think that's it about in terms of questions that we have from the audience. Thank you very much for joining in. And if you have any questions, feel free to drop in a message to research@cal.lk and we will be happy to accommodate. Thank you very much and hope to see you in another session soon.
Thank you.